It is a structure specifically designed for cross-border capital flow, tax efficiency, and access to specific public markets.
Exactly. And the company we're talking about is Hotung Investment Holdings Limited. They are a microcap venture capital and private equity firm.
Okay, so we're talking VC and PE.
Yeah. And our goal today is to completely dismantle this operation and look at the gears, because we have a mountain of source material to get through today.
It's a deep dive in the truest sense.
Right. We're going to unpack this 30-year proprietary deal network they have. We'll look at a financial scorecard that is just riddled with seeming contradictions and a frankly astonishing 35% discount to the company's own net asset value.
Which is wild.
It is. So ultimately, we're trying to answer a simple but incredibly difficult question for you listening at home. Is this an overlooked gem hiding in the microcap wilderness? Or is it basically a value trap that will just eat your capital slowly over time?
Well, to answer that, I think we have to start by looking at their survival timeline. Because in the world of venture capital, mere survival is actually a metric of success. And Hotung has been operating since 1987.
Wait, 1987? That is practically the Paleozoic era for venture capital in Asia.
It really is. I mean, think about the macroeconomic shocks they've had to navigate just to stay alive since then.
I can't even imagine.
Right, so they survived the 1997 Asian financial crisis, which, let's be honest, completely wiped out heavily leveraged financial institutions all across the region.
Yeah, that was a bloodbath.
Then they survived the dot-com bust in the early 2000s, the 2008 global financial crisis, and obviously the recent pandemic.
Right.
A venture capital firm simply does not survive those consecutive extinction-level events unless it has a very specific and likely hyper-conservative DNA.
And their track record really backs up that staying power. Like, the sources show they have backed more than 700 companies over those decades.
That's a massive portfolio.
And out of those, they've achieved more than 200 successful exits.
Yeah, and we should probably clarify the mechanics of an exit here, right? No. Because it's literally the entire point of the VC business model.
Good idea. Break that down for us.
So when Hotung invests in a private, unlisted startup, their money is locked up. They can't just log into a normal brokerage account and sell their shares on a Tuesday.
Right. It's not like dumping Apple stock.
Exactly. They only realize a return on that capital through a liquidity event, which we call an exit. And that usually takes two forms. Well, first is an initial public offering, an IPO. The startup goes public, and Hotung can finally sell their shares on an open exchange. Or the second is a trade sale, where a larger corporation outright acquires the startup for cash or stock.
Right. And the sources highlight that these aren't just small regional base hits for Hotung. I mean, some of their exits have been absolute home runs that ended up listing on the NASDAQ or the New York Stock Exchange.
Oh, wow. Okay.
Yeah. So we know they have a proven mechanism for finding and nurturing startups. Now let's look at how they actually structure the business to do that on a daily basis. The operation is split into two segments, the investment segment and the fund management segment.
Right. So the investment segment is the core engine. This is where Hotung takes its own balance sheet capital, literally its own money, and deploys it into equity stakes, seeking capital appreciation.
And the other side.
The fund management segment is smaller, but structurally really important. This is where they manage third-party money. So they gather capital from outside investors and manage it for a fee.
Okay, I want to drill down on that fund management side for a second, because the sources mention they earn revenue through, quote, assets under management and carry fees.
Ah, yes. The classic PE model.
We really need to define those because they are the absolute lifeblood of private equity, but they are completely alien concepts if you're just used to buying stocks in normal retail companies.
Yeah, it really comes down to how a fund manager gets paid for their expertise. So the first part is the management fee. That's based on assets under management, or AUM.
So basically how much money they're holding on to.
Exactly. If outside investors give Hotung $100 million to manage, Hotung might charge a flat 2% annual fee just to keep the lights on, pay their analysts, run the operation.
Got it.
And they get that $2 million every single year, regardless of whether the investments go up or down.
Nice gig if you can get it. But the real money, like the asymmetric upside, that's in the carry. Right. Carried interest.
Precisely. Carried interest is a share of the actual profits. The standard model is that the fund manager gets 20% of the profits generated by the fund.
Just off the top.
Well, usually after a certain minimum return threshold, what they call the hurdle rate, is met for the outside investors. So let's say Hotung doubles that $100 million fund to $200 million.
Okay, a huge win.
Right. They don't just get their standard 2% management fee. They actually get to keep 20% of that $100 million profit.
Oh, wow. So $20 million just in carry.
Exactly. Carry is what aligns the incentives of the fund manager with the outside investors. And it's what creates those massive revenue spikes when they have a big, successful exit.
Okay, so that covers how they make money on other people's capital. But the truly mind-bending part of Hotung's financials, and I mean, this requires a total rewiring of how you think about corporate accounting, is how they record revenue for their main investment segment.
Yeah, this part throws a lot of people off.
Right, because if I pull up the income statement for Apple, their revenue is a hard number. It represents the iPhones they physically sold to actual customers. If I look at Ford, it's the trucks that rolled off the lot.
But Hotung does not sell a product or a service in their primary segment. In their accounting, top-line revenue is defined simply as investment gains or losses, plus dividends received.
I really want to make sure we don't gloss over this because I think this is the single most confusing thing for a retail investor looking at a financial firm.
It's super counterintuitive.
It is, because look, if I buy a share of Tesla in my personal brokerage account, and the stock drops 10% today, I don't go tell people I had negative revenue for the day.
No, you just have an unrealized paper loss.
Exactly. But for Hotung, an unrealized paper loss on the companies they own actually flows all the way to the top of their income statement. It literally turns their official revenue negative.
Yeah, and that is the defining quirk of mark-to-market accounting, which, by the way, is legally required for financial holding entities.
So they have to do it this way.
They do. Let's think about it mechanically. Hotung holds a portfolio of financial assets. The accounting rules dictate that at the end of every single reporting period, so every quarter or half year, they must look at the current fair market value of everything in that portfolio.
Okay.
And if the overall value of the portfolio has decreased since the last time they checked, they have to recognize that decrease immediately on the income statement.
Okay, let's use an analogy to make this visceral. Imagine you own a massive commercial farm.
Okay, I'm a farmer.
In normal accounting, your revenue is the money you get when you actually harvest the wheat, put it on a train, and sell it to a bakery.
Makes perfect sense.
But in mark-to-market accounting, your revenue is intrinsically tied to the fluctuating daily commodity price of the unharvested wheat that's still just sitting out in your field.
That's a really helpful way to visualize it.
So if a report comes out saying global wheat supplies are at record highs, the market price of wheat plummets. Your wheat is still perfectly fine. It's still in the field. You haven't sold it for a loss at all.
Right, nothing physically changed.
Exactly. But under these rules, because the market values your unharvested crop less today than it did yesterday, you have to report a massive loss on your income statement. Your revenue for the quarter is literally a negative number.
And, you aren't just speaking hypothetically here. The sources show that this exact dynamic triggered a severe financial event for Hotung very recently.
Wait, really? When?
In the first half of 2025, Hotung literally posted negative revenue.
Wow. So it wasn't just a bad quarter where revenue dropped 10%. The top line was mathematically below zero.
Yes, below zero. And it was almost entirely driven by mark-to-market hits on their portfolio. The broader market conditions deteriorated, the theoretical value of their holdings dropped, and that unrealized paper loss dragged their revenue straight into negative territory.
That is insane.
Right. If you're an algorithm blindly scanning financial filings, or just an investor who doesn't understand venture capital accounting, seeing negative revenue makes the company look like it is in the middle of a catastrophic bankruptcy. But in reality, it is purely an accounting reflection of asset price volatility.
Which is terrifying, honestly. I mean, if my business's top-line revenue can swing wildly below zero just because market sentiment shifted, how on earth do I plan for the future?
It's incredibly difficult.
How do I pay my analysts? How has Hotung managed to survive since 1987 if their core revenue engine is completely exposed to the violent whims of market valuations?
Well, the answer lies in how they actually source the assets that eventually go into that portfolio. They don't just buy random stocks on the open market like you or I would.
Right.
They operate in the private markets, which means their survival is entirely dependent on their competitive advantage, their moat.
Okay, let's dive into that, because if we look at traditional business moats, Hotung fails every single test.
Pretty much, yeah.
They don't have switching costs. There is no customer base that is locked into their software. They don't have network effects like a social media platform. They don't have a low-cost production advantage because they don't manufacture physical goods.
No widgets here.
Right. So in the brutal, hyper-competitive world of Asian venture capital, what protects their castle?
The sources assess their moat as narrow but highly stable. And it is built entirely on intangible assets, specifically a deeply entrenched 30-plus year proprietary deal flow network in Taiwan.
Okay, we need to define proprietary deal flow because it sounds like boring corporate jargon, but it's actually the holy grail of investing.
It really is. It is the difference between buying wholesale and buying retail, but applied to private companies.
Okay, unpack that.
Well, in the public markets, everyone sees the exact same information. If you want to buy Microsoft, you pay the same price as the largest hedge fund in the world. The information is public, the price is public, and the access is universal.
Right. It's an even playing field.
But the private markets operate on the exact opposite principle. Information is highly asymmetric, and access is strictly restricted.
So if I just have $1 billion in cash, I can't just fly to Taipei, find the best stealth AI startup, and just force them to take my money?
Absolutely not. In fact, the absolute best startups, the ones founded by former TSMC engineers with revolutionary technology, they usually don't even need to ask for money.
Really?
Oh, yeah. They are oversubscribed before they even officially open a funding round. They have multiple VC firms begging to give them capital. In that scenario, money is just a commodity. Every VC has money.
So how does the startup founder actually choose whose money to take then?
They choose the investor who brings the most strategic value. They want the firm that can open doors, introduce them to key manufacturing partners, help them navigate local regulations, and provide credibility.
So it's about connections.
Exactly. They want the investor with the deepest roots in the ecosystem. And this is where Hotung's true moat reveals itself. The sources highlight a massive structural advantage. Since 2011, Hotung has been actively engaged by Taiwan government-owned investment programs.
Okay, I really want to push back on this, because whenever I hear government relationships as a business model, it immediately sets off alarm bells for me.
It's a fair reaction.
It just sounds so fragile. It sounds like cronyism. Like, what happens if there's an election and a totally new political party takes power? What happens if the executive at Hotung who plays golf with the finance minister just retires?
Right.
If your entire competitive edge is just a Rolodex of government officials, isn't that a moat built on sand?
If it were merely personal favors, yes, you would be absolutely right. That is known as key man risk, and it is a massive vulnerability in finance. But the sources indicate this is an institutionalized engagement.
Institutionalized how?
Well, since 2011, we are looking at roughly 15 years of continuous co-investment and mandate execution. They aren't just relying on handshakes at the country club. They are actively managing or co-investing alongside sovereign or state-backed capital.
How does that actually generate deal flow, though? Walk me through the mechanics of how a government mandate gets Hotung into a hot startup.
Okay, so the Taiwanese government, like a lot of governments, operates specialized funds to stimulate specific sectors of their economy. Think semiconductors or biotechnology. They want to invest public money to grow these industries, but they don't want government bureaucrats trying to pick winning startups. They aren't good at it. So they allocate that capital to trusted, veteran private sector managers like Hotung to deploy it for them.
Oh, I see.
So when Hotung approaches a startup, they aren't just bringing Hotung's money, they're bringing capital backed by the state, which often comes with implied regulatory support, easier access to domestic grants, and just massive institutional credibility.
Oh, okay. So it creates this virtuous cycle. The best startups want the government-backed money for the strategic advantage, which means Hotung gets to see the best deals first.
You got it.
And this proprietary deal flow ensures Hotung gets in at the ground floor at lower valuations, which then generates the outsized returns that allow them to survive the macroeconomic shocks we talked about earlier.
Exactly. A brand new VC firm with a bottomless checkbook right out of Silicon Valley could set up an office next door, but they cannot just replicate a 15-year institutional partnership with the Taiwanese state.
No amount of money buys that instantly.
Right. That is an incredibly high barrier to entry. However, we do have to issue a pretty severe warning to the listener here. All of this analysis regarding their competitive position is something you have to verify yourself.
Right, because there are 0 third-party moat ratings on this stock. You can't just log into Morningstar and read a 50-page breakdown of Hotung's competitive advantages.
Exactly.
The major Wall Street banks simply aren't covering it. This is the reality of operating in the microcap space. You are entirely off the radar of the financial establishment. You are doing the homework without an answer key.
Which logically leads us to the next massive question. If we accept that their moat, their deal flow network, is solid enough to keep them alive, how are they planning to actually grow?
Because a static network eventually degrades, right?
Right. The technology sector in Asia is moving at blinding speed. You can't just keep backing the exact same types of companies you backed in 1999 and expect to thrive.
And this is where we look at their catalysts for growth. Again, we have to throw out the normal playbook. Like we said, a software company grows by increasing its marketing spend and lowering its customer churn rate.
Yeah, Hotung doesn't have marketing spend or customer churn.
Exactly. Their growth relies entirely on capital allocation, where they point their money, and the sources outline 3 distinct growth drivers for them.
Okay, so the first driver is aggressive sector rotation. Management is deliberately funneling new capital into 3 extremely specific areas: semiconductors, AI-related businesses, and precision manufacturing.
Let's contextualize this, because this isn't just a random assortment of tech buzzwords to sound cool. This sector rotation is a direct play on the single largest macroeconomic shift happening in the world right now, the China Plus One strategy.
Oh, definitely. We need to unpack that. For the last 30 years, the prevailing logic of global manufacturing was hyper-consolidation in mainland China.
Put everything in one place?
Right. It offered scale, infrastructure, and cheap labor that nowhere else on Earth could match. But over the last 5 to 7 years, a confluence of massive shocks has completely broken that logic.
Yeah, you had severe geopolitical trade tensions.
And you had the pandemic, which proves that relying on a single country for your entire supply chain is a catastrophic risk. Plus, you have rising labor costs domestically in China.
So massive multinational corporations, the Apples, the Dells, the huge automotive giants, they looked at their supply chains and basically panicked.
Yeah, they realized they needed a backup plan fast.
And they aren't completely abandoning China. That's why it's called China Plus One. But they are aggressively building secondary parallel supply chains across the rest of Asia to mitigate their risk.
And this massive relocation of physical capital and manufacturing infrastructure is exactly what Hotung is targeting. By pivoting heavily into precision manufacturing and AI hardware, they are positioning themselves to back the mid-cap companies and specialized suppliers that will actually build out this new decentralized Asian supply chain.
Which ties perfectly into their second growth driver, geographic expansion beyond Taiwan. If the supply chain is migrating, Hotung has to migrate with it.
They have to follow the money.
Exactly. The sources specifically highlight that they are expanding into Southeast Asia with a major focus on Thailand, as well as looking at South Asia and the US.
Thailand is actually a brilliant example of this strategy in action. Thailand is rapidly positioning itself as the Detroit of Southeast Asia.
Really?
Yeah. It is absorbing massive amounts of foreign direct investment from companies relocating automotive and electronics manufacturing out of China. Hotung realizes that if they only invest in Taiwanese companies, they miss the broader regional boom.
Right. You can't be purely local anymore.
So they're taking their 30 years of operational expertise and attempting to apply it in these new high-growth geographies.
Okay, so driver 1 is rotating into AI and semis to capture the macro trend. Driver 2 is physically following the money into places like Thailand. But it's driver 3 that really grounds this whole conversation for me.
Because it's tangible.
Exactly. Because investing in high-precision manufacturing sounds great in theory, but it takes years to play out. Driver 3 is happening right now, and it involves a staggering amount of actual cash.
Yes. The sources note that in 2025 alone, Hotung realized over 700 million new Taiwan dollars in cash proceeds from divestments.
I cannot stress how important this number is for validating their entire business model. I mean, we spent the first 10 minutes of this conversation agonizing over mark-to-market accounting, where Hotung's revenue can turn negative just because of paper losses on unrealized assets.
Right, it makes the company look like a house of cards built on spreadsheets.
Exactly, but 700 million NTD in realized cash proceeds. That is the ultimate proof of concept.
Because the investment means the life cycle of the investment is complete. They found a startup, they invested capital, the company grew, and Hotung finally hit the exit button.
They cashed out.
They sold their shares to a willing buyer in the real world and wired 700 million NTD back into their corporate bank account. This isn't an auditor's estimate. It is hard, fungible liquidity.
Which completely shifts how we have to analyze their financials. If they just harvested this massive windfall, the obvious question is, how efficiently are they managing this mountain of cash? Are they a well-oiled capital machine, or are they just, hoarding it?
Well, let's pull up the financial scorecard and run the diagnostics. The sources categorize Hotung fundamentally as a capital return play.
Okay, define that.
This is a crucial framing.
Yeah.
If you are an investor looking for a company that is going to reinvest every single penny it makes into hypergrowth R&D to take over the world, like an early Amazon, this is not the stop for you.
Not at all.
No. A capital return play is designed to generate cash and systematically hand it back to the shareholders.
So it's more akin to a mature utility company or a telecommunications giant, but operating in the venture capital space.
Exactly. And when we look at the scorecard through that lens, there are some very bright, undeniable green lights. The first is their revenue compound annual growth rate, or CAGR. From fiscal year 2022 to 2025, they posted a positive 21.7% CAGR.
Let's break down KGR for a second. It's not just taking the growth from year 1 and year 3 and averaging them. It's the rate of return that would be required for investment to grow from its beginning balance to its ending balance, assuming the profits were reinvested at the end of each year.
Right. It smooths out the volatility.
Exactly. And a 21.7% KGR over a multi-year period, especially in an environment with high interest rates and massive market volatility, is incredibly robust.
It really shows that despite the terrifying mark-to-market swings we discussed, the underlying trajectory of their asset accumulation is pointing sharply upward.
Okay, what's the next green light?
The second green light is even more impressive for a financial firm. They have absolute zero borrowings.
Wait, zero debt?
None. Zero. This means if you try to calculate a standard solvency metric like the interest coverage ratio, which is earnings before interest and taxes divided by interest expense, the formula literally breaks because the denominator is zero. They don't owe anyone a dime in interest.
That is almost unheard of in private equity. I mean, usually these firms use massive amounts of leverage borrowed money to juice their return.
Oh yeah, standard playbook.
Right. If they buy a company, they load it up with debt to magnify the upside. Hotung is playing a completely different, infinitely more conservative game.
And that conservatism is exactly what allows them to fund the third green light. A strong, consistent capital return policy. They have maintained a steady dividend payout for at least 5 consecutive years.
Okay, so we have over 20% annualized revenue growth, a completely debt-free balance sheet, and a 5-year streak of paying dividends. It sounds like a fortress.
It does.
But there is a glaring, blinking red light on this dashboard that we cannot ignore. The return on invested capital, or ROIC, is sitting at a dismal 3.3%.
Yes, 3.3% ROIC is a mathematically concerning number.
Let me play devil's advocate here because this seems like a massive contradiction to me. How can a company be so successful at generating $700 million cash exits, have zero debt, grow top-line revenue by 21%, and yet have a return on invested capital that barely beats inflation?
It's a paradox.
It's like having a team of genius engineers design a state-of-the-art rocket engine and then using it to power a golf cart. Why is their capital efficiency so terribly low?
To understand the paradox, we really have to look at the mechanics of the ROIC formula. Return on invested capital is essentially your net operating profit divided by your invested capital.
Okay, simple enough.
Right, but the problem for Hotung isn't necessarily the numerator. They are making profits, as evidenced by the cash exits. The problem is the denominator. They have a massive swelling base of equity and cash sitting on their balance sheet.
Because they have zero debt and they keep retaining large cash buffers from these exits, their total capital base is just huge.
Exactly. Imagine you have $100 and you make a $10 profit. Your return is 10%.
Right.
Now imagine you have $1,000 sitting in a vault. You only deploy $100 of it to make that same $10 profit, and the other $900 earns zero. Your total profit is still $10, but your return on the total $1,000 of capital is now only 1%.
Oh, that makes so much sense.
By hoarding cash and refusing to use leverage, Hotung mathematically crushes its own ROIC.
So it's a deliberate choice. A 3.3% ROIC isn't a sign of operational incompetence. It is the structural footprint of extreme financial paranoia.
I wouldn't call it paranoia, but definitely extreme conservatism.
Right. They are prioritizing absolute bulletproof capital preservation over aggressive capital efficiency. They would literally rather accept a paltry 3.3% return than risk their cash pile on marginal deals or take on debt to juice the numbers.
It goes right back to their DNA. Surviving the 1997 Asian financial crisis teaches you that leverage kills, period. They have built a balance sheet designed to survive an apocalypse, not to win a quarterly efficiency contest.
That's a great way to put it.
But, even a fortress can be breached. If their entire strategy is to hunker down, protect the principal, and pay the dividend, we have to identify what external forces are powerful enough to threaten that strategy.
Which brings us to the risks, and the sources break these down into escalating tiers. Let's start with the moderate risks, the yellow flags. The first is disruption and competition.
Yeah, we touched on this a bit when discussing the moat. The venture capital industry in Asia is incredibly fragmented. You have hundreds of funds, family offices, and corporate venture arms, all hunting the exact same promising tech startups in Taiwan and Southeast Asia.
And because Hotung primarily just provides capital, which is fundamentally a commodity, they have absolutely zero pricing power.
None.
If they want to invest in a hot AI startup, and Sequoia Capital also wants to invest, Hotung can't dictate the valuation. They have to pay the market rate. They are a price taker, not a price maker.
Correct. The second yellow flag is far more systemic to their internal structure. Concentration risk. The sources reveal that roughly 2/3 of Hotung's investment portfolio, so 66% of their assets, sits in unquoted level 3 assets, primarily concentrated in Taiwan.
We need to stop the car right here and dissect this, because level 3 assets is one of those accounting terms that sounds incredibly boring, but is actually terrifying if you don't understand it.
Oh, it's spooky stuff.
Right. How do auditors actually classify the assets a company holds?
Okay, so the accounting framework uses a 3-level hierarchy. It's basically based on how easy it is to independently verify an asset's value. Level 1 is the gold standard.
The publicly traded stocks.
Exactly. These are assets with active, liquid, public markets. Think shares of Apple or U.S. Treasury bonds. You don't have to guess what they're worth. You just look at the ticker price at 3:59 p.m., and that is the exact value. The valuation is 100% transparent and objective.
And if Hotung's portfolio was all level 1 assets, we wouldn't even be having this debate. We'd know exactly what they are worth at any second.
So what is level 2?
Level 2 assets are slightly murkier. They don't have a direct, active market price, but you can figure out their value using highly correlated observable inputs.
Give me an example.
Like a specific type of corporate bond that rarely trades. You can look at the yield curve of similar frequently traded bonds to triangulate a highly accurate objective price. It requires a bit of math, but the inputs are still public.
Which leaves level 3, the black box.
Level 3 assets are the wild west of accounting. These are assets that are highly illiquid, do not trade on any public exchange, and crucially, have absolutely no observable market inputs to base a valuation on.
Let's invent a company to make this real. Say Hotung invests $10 million in Taipei Quantum AI, a private startup developing a new microchip. There's no public stock price. There are no similar quantum AI companies to compare them to. How does Hotung's accounting department decide what that $10 million stake is worth at the end of the year? They have to build complex internal valuation models. They use techniques like discounted cash flow analysis, projecting what Taipei Quantum AI might earn 5 years from now, and then applying a massive discount rate to account for the risk that the company might fail.
That involves a lot of guesswork.
Or they might look at the revenue multiples of vaguely similar public companies and apply a heavy illiquidity discount.
But all of those inputs, the growth projections, the discount rates, the comparables, they are all subjective assumptions made by Hotung's own internal management.
Exactly. And that is the crux of the risk. When 2/3 of your entire portfolio is level 3, it means the vast majority of the company's stated net worth is based on internal estimates, not objective market reality.
That's huge.
The risk is that these internal models might be overly optimistic. If a macroeconomic shock hits and Hotung is forced to liquidate those assets quickly, they might discover that the actual real-world buyers are only willing to pay 50 cents on the dollar compared to what Hotung's internal spreadsheets claim the assets were worth.
It is severe valuation risk. You are essentially trusting management to grade their own homework.
Exactly.
Combine that with the geographic reality that these level 3 assets are heavily concentrated in Taiwan, and you are staring down the barrel of the absolute biggest, reddest flag in this entire deep dive. Outside forces, specifically geopolitics and currency swings.
Yeah, the geographic concentration in Taiwan cannot be overstated. Taiwan is the geopolitical focal point of the 21st century due to its dominance in semiconductor manufacturing and its incredibly tense relationship with mainland China.
It's always in the news.
Any escalation in rhetoric, let alone physical action in the Taiwan Strait, instantly alters the risk premium global investors attached to Taiwanese assets.
Right. If you are holding illiquid private equity stakes in Taiwanese companies and geopolitical tensions spike, the value of those level 3 assets doesn't just dip. It could become fundamentally impaired overnight as foreign capital flees the region.
100%.
But even if we totally ignore the threat of military or political crisis, the day-to-day macroeconomic reality of their corporate structure creates a massive constant vulnerability through currency risk.
Oh, this part is fascinating. Let's map out the currency triangle Hotung operates in. It is a logistical nightmare for a CFO.
Paint the picture.
Okay, so you have their operations and the bulk of their private investments in Taiwan, which means they're operating and generating returns in new Taiwan dollars, NTD. But they also invest in U.S. markets, and the global tech sector benchmarks heavily against the U.S. dollar.
Okay, that's 2 currencies.
Finally, the holding company itself is listed on the Singapore Exchange, which means their ultimate financial reporting and share price are denominated in Singapore dollars, SGD.
I want to do the math on this to show exactly how a currency swing can completely obliterate a great investment. Imagine Hotung invests in a Taiwanese software company. The company executes flawlessly. Over 2 years, the value of Hotung's stake doubles from 100 million NTD to 200 million NTD. Operationally, it is a massive win.
Right, a clean 100% return on the underlying asset.
But let's say over the same 2 years, the global macroeconomic environment shifts. The U.S. Federal Reserve raises interest rates aggressively, drawing capital out of emerging markets. As a result, the new Taiwan dollar weakens significantly against both the U.S. dollar and the Singapore dollar. Let's say it depreciates by 20% against the SGD.
Oh, wow. When Hotung goes to consolidate its financial statements at the end of the year to report to its shareholders in Singapore, they have to translate that 200 million NTD back into SGD.
Right.
Because the exchange rate has moved so violently against them, that massive 100% operational gain gets severely diluted, or in some extreme cases, completely wiped out by the translation loss.
You can have the best venture capital analysts in the world picking the absolute best startups, but if the central bank exchange rates move the wrong way, your reported revenue just plunges.
It's out of their control.
And the sources are incredibly explicit about this. This exact toxic cocktail unfavorable fair value movements on their level 3 assets, combined with foreign exchange losses, is exactly what caused their massive financial loss in the first half of 2025.
They are completely exposed to macroeconomic tides they cannot control.
It sounds incredibly stressful. If I'm an investor, why would I subject myself to a black box portfolio of level 3 assets operating in a geopolitical hotspot subject to a three-way currency grinder?
Because of the fortress.
The fortress.
We have to bring the analysis back to the balance sheet. A highly leveraged private equity firm facing that exact same H1 2025 scenario with negative revenue and massive FX losses, they would be facing margin calls from their lenders.
Oh, absolutely.
They would be forced to sell their illiquid assets at fire sale prices just to service their debt, triggering a literal death spiral.
But Hotung has zero debt. They don't have lenders breathing down their neck.
Exactly. They absorbed the multi-million-dollar blow, reported the negative revenue, and just kept going. They didn't have to liquidate a single core asset. The zero leverage strategy and that massive cash buffer act as an impenetrable shock absorber. They are built to take hits that would vaporize other firms.
Well, let's actually pull up the X-ray of that balance sheet then, because this is where the mystery of this company reaches its absolute peak. The sources run through a forensic 5-point red flag check to test the structural integrity of the company's financials.
And it reads remarkably clean for a financial firm. First, they check for goodwill.
Remind us what that is.
In accounting, goodwill is an intangible asset that arises when you overpay for an acquisition. If goodwill makes up more than 50% of your assets, it's a huge red flag because it's essentially thin air that can be written down at any moment. Hotung passes this easily. There's basically zero goodwill on the balance sheet.
Okay, pass. Second, they look at receivables. Are receivables growing faster than revenue? If a company's booking massive revenue, but their receivables are skyrocketing, it means they are claiming sales but not actually collecting the cash. Classic
sign of accounting manipulation.
Or just a failing business model. Hotung passes this as well. Their receivables are very small and actually shrinking.
Third is the leverage check. Is debt greater than cash? We've beaten this drum repeatedly today, but it is the defining characteristic of the firm. They have zero borrowings against roughly 1.4 billion new Taiwan dollars in cash, a completely clean pass.
Awesome. Fourth, they check for preferred stock. Preference shares sit above common stock in the capital structure and can siphon off dividends and value, which just complicates the picture for normal retail investors. Hotung passes, no complex preference share structures here.
But the fifth point in the forensic audit actually throws a flag.
Oh.
Yeah. If you look at the equity section of the balance sheet, the retained earnings line is negative. They're carrying accumulated losses.
Okay, stop there. Accumulated losses sounds catastrophic. If I run a lemonade stand and my retained earnings are negative, it means I've lost more money over the life of the business than I've made. How is this not an existential threat to Hotung?
You have to understand how retained earnings interact with the rest of the equity base. Retained earnings is just one line item. It represents the cumulative net income or loss of the company since inception, minus dividends paid.
Okay.
Because Hotung operates with mark-to-market accounting, they have taken massive non-cash paper losses during market downturns over the last 30 years, which drags that specific line item into the negative.
But that doesn't necessarily mean the company is insolvent.
Precisely,
Yeah.
Because you have to look at the massive positive offset sitting right above it on the balance sheet.
Yeah.
The share capital and share premium accounts.
Right, the money they raised.
Exactly. Early in its life, Hotung raised a tremendous amount of capital from investors. The share premium represents the money they raised above the nominal par value of the shares. This paid-in capital forms a massive equity cushion.
So even though the accounting rules force them to record cumulative losses on one line due to market volatility, the sheer size of the initial cash pile they raised, and still hold, means the overall equity base of the house is incredibly solid.
Yeah, it's a technical accounting quirk, not a sign of impending bankruptcy.
The balance sheet is fundamentally sound. But that soundness leads us to the most baffling paradox of the entire deep dive. The ultimate reveal of this X-ray is the net asset value.
This is where it gets crazy.
Let's define this clearly for everyone. Net asset value, or NAV, is exactly what it sounds like. If you take every single asset Hotung owns, the 1.4 billion NTD in cash, the stakes in 700 startups, the office equipment, and you subtract their liabilities, which, as we know, are basically zero, you get the net worth of the company.
Simple math.
If you divide that net worth by the number of shares outstanding, you get the NAV per share.
And the company publicly discloses that their NAV per share is roughly 57 new Taiwan dollars.
Which means, theoretically, if the company liquidated today, sold everything at its stated value, and handed the cash back to shareholders, every share would be worth 57 NTD.
Theoretically, yes.
But if you open your brokerage app right now and look at the actual share price on the open market, it is trading at the equivalent of only 37 to 38 new Taiwan dollars.
It's unbelievable. The public market is pricing this stock at a staggering 35% discount to its own stated asset-backed net worth.
I want to offer an analogy here because it fundamentally changes how you view this investment. Buying Hotung is not like buying a normal business where you are paying for future growth.
No, not at all.
Buying Hotung is like someone offering to sell you a locked, reinforced titanium wallet. The owner of the wallet shows you an audited certificate proving that there is a crisp, real $100 bill locked inside, but the owner is offering to sell you the entire wallet for $65.
And your immediate rational reaction shouldn't be to blindly celebrate the discount. Your reaction should be immense skepticism. You ask, why are you selling me $100 for $65? What is the catch?
Exactly. Are the locks jammed? Is the key lost at the bottom of the ocean? Can I ever actually get the wallet open to spend the $100? This is known as a holding company discount, and it happens when the market fundamentally does not believe it can easily access the underlying value of the assets.
The market is looking at Hotung and seeing two massive locks on that wallet. The first lock is the level 3 assets.
Those illiquid private startups.
Yes. The market is looking at Hotung's internal valuation models for all those unquoted Taiwanese startups and saying, we don't trust your math. We think you are wildly overvaluing your private portfolio. Therefore, we refuse to pay full price for your stated NAV.
And the second lock is the total lack of liquidity and catalysts. Even if the market believes the NAV is completely real, Hotung is a microcap stock with no structural mechanism to force the discount to close.
Right.
They aren't liquidating the company tomorrow. So an investor might buy the stock at a 35% discount, hold it for 10 years, and find it still trading at a 35% discount. You are trapped in the discount.
This profound disconnect creates a nightmare scenario. If you try to use traditional financial metrics to build a valuation model for Hotung, if you apply the standard toolkit, it will actively lie to you.
Now let's walk through those broken tools, because normally the very first thing an investor looks at is the price to earnings ratio, the PE. The sources note that Hotung's current PE is sitting around 18 to 19 times trailing earnings.
If you are analyzing a stable consumer packaged goods company, an 18x PE gives you a decent baseline for how the market is valuing their future cash flows based on their past performance. But for Hotung, relying on a trailing PE is incredibly dangerous.
Because the earnings part of the PE ratio is completely untethered from operational reality.
Exactly. As we discussed deeply in the risk section, their earnings are dominated by non-cash, mark-to-market fair value adjustments, and violent foreign exchange translation swings.
So it's mostly noise.
Totally. Hotung could have a brilliant operational year, but if the NTD depreciates against the SGD, their reported earnings will collapse, causing the PE ratio to artificially skyrocket to 100x. Conversely, a favorable currency swing could make their earnings look massive, dropping the PE to 4x, making it look absurdly cheap.
So a single-year PE for a mark-to-market financial holding company is practically a mirage. It tells you almost nothing about the long-term earning power of the underlying assets. What about other metrics? The sources explicitly list a few that we just need to throw in the trash.
Well, price to sales is completely meaningless because they don't have standard sales revenue. Price to gross profit is equally useless because the concept of cost of goods sold doesn't exist for a venture capital firm.
And we also have to ignore price to free cash flow. We touched on this earlier, but it really bears repeating. In a normal company, buying equipment is an investing activity. For Hotung, buying and selling massive equity stakes in startups is their day-to-day operating activity.
Right, that's what they do.
When they make a 700 million NTD divestment, or when they deploy 500 million into a new fund, it creates massive, lumpy distortions in their operating cash flow. It is literally impossible to model a smooth, predictable, free cash flow yield.
So if you throw out PE, you throw out price to sales, and you throw out free cash flow, what is left to anchor valuation?
You are basically left with two very primal, very blunt instruments. You are buying the dividend, and you are buying the NAV discount. The sources note the dividend yield is currently hovering between 6 to 7%.
Which is undeniably attractive, particularly in an environment where safe government bond yields might be compressing. And because we know they have a fortress balance sheet with 1.4 billion NTD in cash and zero debt, we can have a relatively high degree of confidence that the dividend is safe, at least in the medium term.
They aren't borrowing money to pay it.
Exactly. It's backed by real cash.
So the thesis essentially becomes, I will buy this locked wallet at a 35% discount. I will sit patiently and collect a 6 to 7% yield every year while I wait. And I will cross my fingers and hope that eventually the broader market wakes up, realizes the underlying assets are genuinely valuable, and bids up the share price to close that 35% gap to NAV.
But that thesis relies entirely on the market eventually changing its mind. Which brings us to an analysis of the current market mood. Why hasn't the market woken up yet? Let's look at the actual price action and listen to the competing narratives of the bulls and the bears.
The recent price action paints a very specific picture of a stock that is moving but definitely struggling to keep up. Over the last 12 months, BLS is up about 19%. The 52-week trading range is between 1.32 and 1.72 Singapore dollars, and it is currently hovering in the upper half of that range around 1.62 SGD.
Now, on an absolute basis, a 19% return in 12 months is fantastic. Any portfolio manager would be thrilled with that contribution. But investing is always relative. You have to measure performance against the opportunity cost of just holding a broad market index.
And that is where the narrative shifts pretty hard. Over that exact same 12-month period, the Straits Times Index, The primary benchmark for the Singapore market where Hotung is listed is up roughly 31%.
So despite posting record profits driven by massive 700 million NTD cash divestments, Hotung underperformed the broader market by more than 10 full percentage points. That is severe structural lag.
Why is it lagging so badly when the underlying business just had such a demonstrably huge cash realization? It really comes back to the concept of the orphan stock. There is an absolute void of institutional attention here. There is zero verified sell-side analyst coverage.
We have to understand the psychology of institutional investing to see why this matters. If a portfolio manager at a major fund wants to buy $50 million of a stock, they need to justify that decision to their risk committee.
Right, covering their own back.
Exactly. If they buy a heavily covered blue chip stock and it goes down, they can point to the 10 Wall Street analysts who also said it was a good buy. Nobody gets fired for buying IBM, as the old saying goes.
But if they buy a completely uncovered microcap Taiwanese VC firm incorporated in Bermuda and it drops 20% because of a random currency swing, the portfolio manager looks reckless.
They look foolish.
There is no institutional safety net. Because major banks aren't publishing 50-page reports on Hotung, institutional money refuses to touch it. And without institutional money flowing in, the stock simply doesn't have the buying volume required to close a 35% NAV discount. It is trapped in a low liquidity purgatory.
Furthermore, the sources flag a specific governance event that gives conservative investors another reason to pause. Recent turnover in the chief financial officer position.
In a standard company, a CFO leaving is disruptive. But in a mark-to-market venture capital firm where 2/3 of the assets are opaque, level 3 private investments, the CFO isn't just managing the budget.
Oh, not at all.
The CFO is essentially the chief evaluation officer. They are the ones signing off on the internal models that dictate the company's stated net worth. When that person leaves, it creates a massive vacuum of trust.
The market hates uncertainty.
Exactly. The market naturally assumes a defensive posture, wondering if the new CFO might look at the books and decide to write down the value of those level 3 assets. It further suppresses the price.
So we have a perfectly balanced cage match between the bull and bear narratives.
Let's summarize the arguments. If I'm taking the bull position, I am aggressively pointing to the balance sheet. I see a company trading at a 35% discount to its assets. I see an impenetrable fortress of zero debt and 1.4 billion NTD in cash.
Very strong points.
And I see a management team that just proved their model works by bringing home 700 million NTD in real cash divestments, enabling a sustainable 6 to 7% dividend yield while we wait for the market to realize how cheap it is.
And if I am the bear, I am countering by pointing to the structural trap. I see an unpredictable mark-to-market income statement that is completely hostage to violent foreign exchange swings and Taiwan's stray geopolitics.
Also true.
I see a portfolio dangerously concentrated in illiquid level 3 assets whose valuation relies on internal spreadsheets rather than actual market reality. And most importantly, I see an orphaned, illiquid stock with zero institutional coverage and recent executive turnover, meaning that 35% discount might never ever close.
It is a phenomenal standoff. It perfectly encapsulates why deeply researching microcaps is so mentally engaging. You have to weigh immense verifiable value against profound structural flaws. But before we close the book on Hotung, we really have to force ourselves to look beyond their 30-year history and their current balance sheet.
Yeah, we have to look to the future.
We have to look at the existential threat looming over the entire financial sector. We need to run Hotung through the AI disruption framework. If human analysts are already ignoring this stock, what happens when artificial intelligence begins to systematically dismantle and reconstruct the venture capital industry?
Now, we must acknowledge a critical mismatch in our tools right off the bat here. The standard AI disruption frameworks, the lenses we use to determine if a company will be automated out of existence, are almost entirely built to evaluate software companies, SaaS business models, and digital platforms.
Okay.
Applying them to a legacy, balance sheet heavy venture capital firm is inherently flawed, but the exercise itself reveals a tremendous amount about Hotung's underlying DNA.
Let's look through the first lens provided in the sources, the liability lens. This asks a simple question. What is the cost of a mistake if an AI takes over the core function of the business? For Hotung, this is rated a definitive green, meaning the business is highly insulated from AI replacement because the human element remains strictly necessary.
Why? Because we aren't talking about AI generating a slightly weird-looking image or writing a bad marketing email. We are talking about deploying millions of dollars of non-refundable capital into private companies.
The stakes are astronomical.
If a large language model hallucinates a financial projection and recommends a bad investment, the resulting capital destruction is absolute. The liability is just way too high. You need human judgment, board-level negotiation, and intuition when you are allocating institutional or government capital.
Exactly. The second perspective is the business model lens, which is rated yellow or moderate risk. We define SaaS, earlier software, as a service. If you sell a monthly subscription to a cloud software tool, an AI could easily replicate your code and offer it for free, destroying your business model overnight.
But Hotung doesn't monetize through subscriptions.
Right. They monetize through assets under management and carried interest fees based on long-term capital appreciation. AI cannot easily replicate a 10-year lockup fund structure.
The third is the physical world lens. This is a purely financial holding company. There are no factories, no logistics networks, no physical supply chains for robotics or AI to optimize or disrupt. It is entirely a game of capital allocation, so this lens is largely irrelevant, rated red.
But the final lens is the most critical, and it goes to the absolute core of Hotung's existence, the network or paper gravity lens. And the sources rate this as strongly green, meaning Hotung is highly protected.
And this brings us all the way back to the discussion we had earlier about level 3 assets and proprietary deal flow. Large language models are incredibly powerful, but they share a fundamental weakness.
Which is?
They can only train on data that actually exists in the digital public square. They need the internet.
And as we established, the private markets operate in the shadows. Roughly 2/3 of Hotung's portfolio is unquoted. The financial data, the founder psychologies, the cap tables of these Taiwanese startups, that information does not live on the open internet.
It lives in closed-door boardrooms in Taipei.
It lives in confidential pitch decks. An AI tool cannot scrape data that is locked in a physical filing cabinet.
The ultimate protection against an omniscient AI is simply refusing to digitize your competitive advantage. Hotung's edge is a 15-year handshake agreement with a Taiwanese government co-investment fund.
Right.
You cannot send ChatGPT to a high-end restaurant in Taipei to charm a government minister into giving you a proprietary allocation in a hot semiconductor startup. The core engine of their deal flow is intrinsically stubbornly human.
That is a very robust defense. But we should explore the avenues for speculation here. How might AI still erode their position, even if it doesn't directly replace them?
Well, I'll push back on the idea of total safety. What if the threat isn't a robot taking the CEO's job? What if the threat is democratization of analysis?
Explain that.
Historically, a massive Wall Street firm had thousands of analysts crunching data, giving them a huge informational advantage over smaller regional players. Hotung survived by relying on local proprietary networks. But what if specialized AI tools suddenly give 5 guys in a garage the analytical firepower of Goldman Sachs?
Exactly. And if an AI can do that, the information edge that regional VC players rely on to correctly price these private deals begins to evaporate.
Exactly.
If every new VC fund has superintelligence, the value of local intelligence diminishes. It places an almost terrifying amount of pressure on the pure relationship aspect of Hotung's moat. If everyone knows exactly what the startup is worth, Hotung can only win the deal based entirely on who they know.
It's a compelling argument. The landscape will shift, and the definition of a competitive advantage in venture capital will have to evolve, even if AI doesn't completely replace the traditional fund structure.
This has been an incredibly dense journey. Let's pull all the threads together. We started by looking at a corporate paradox. A firm listed in Singapore, incorporated in Bermuda, but operating entirely in the high-stakes, hyper-competitive venture capital ecosystem of Taiwan.
Yeah, quite the setup.
We unpacked the terrifying reality of mark-to-market accounting, where their revenue can plunge below zero on a spreadsheet, even as they bring home 700 million new Taiwan dollars in hard cash exits.
We analyzed a fortress balance sheet entirely free of debt, sitting on 1.4 billion NTD in cash, yet deliberately accepting a 3.3% return on invested capital in exchange for bulletproof survival.
We navigated the immense geopolitical and macroeconomic risks of holding opaque, level 3 private assets in the shadow of the Taiwan Strait, subject to a 3-way currency grinder.
That currency grinder is brutal.
And ultimately, we stared at a locked titanium wallet, an orphan microcap stock with zero analyst coverage, ignored by institutions, trading at a massive 35% discount to its own net asset value, but paying a 6 to 7% dividend to anyone patient enough to hold it.
It truly is a masterclass in the complexities, the frustrations, and the unique opportunities of microcap investing in emerging markets.
So as we close the vault door on Hotung today, what is the ultimate takeaway? What is the thought that should linger after the numbers fade?
It forces us to confront a much larger philosophical question about the nature of financial markets.
Okay, let's hear it.
Consider the irony of Hotung's existence. Their entire business model, the reason they get out of bed in the morning, is based on investing in private markets, nurturing companies, and then unlocking premium valuations when those companies finally go public.
Right.
The public market is supposed to be the great liberator of value. Yet, as a publicly listed entity itself, Hotung is being heavily penalized, discounted, and ignored by that very same public market due to the inherent volatility and illiquidity of its assets.
Wow.
It begs the question, does forcing a private equity firm into a publicly traded vehicle actually trap its value rather than liberate it? Are they utilizing the fundamentally wrong structure for their own success?
Are the walls of the public market actually holding the value in instead of letting it out? That is a phenomenal thought to end on. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking past the heavily covered blue chips, and keep exploring the hidden, quiet, completely irrational corners of the market. We'll catch you on the next one.